If you find this video helpful, please don't forget to like, share, and subscribe. So, you've just learned that a company you own is about to undergo a stock split. What should you do? The first and most important step is simple. Do nothing rash. There is no need to panic or rush into a decision. The most practical action is to first verify the news through official sources, such as the company's investor relations website or a press release. Once confirmed, your primary task is to simply be aware of the key dates, specifically the split effective date, which is when the change will be reflected in the market. On that day, you should check your brokerage account. You will automatically see the new higher number of shares and the new lower price per share reflected in your portfolio. Your broker handles all the mechanics for you. The second crucial point is to manage your own expectations and emotions. When you see the stock's price drop dramatically on the split date, for example, from $600 down to $150 after a 4-for-1 split, it can be jarring. Your brain might momentarily scream that you've lost a huge amount of money. This is where your knowledge becomes your power. You must remind yourself that this price drop is a planned, expected, and purely mechanical part of the process. You are not losing value. Your total investment worth remains the same. Staying calm and trusting the math is paramount. Don't let a cosmetic price change trick you into a panic sell that you might later regret. Furthermore, it's essential to understand that there are no immediate tax consequences from a stock split in most jurisdictions, including the United States. You are not selling your shares, you are simply having them restructured. Your original cost basis, what you paid for the shares, is now spread across the new, larger number of shares. For example, if you bought 10 shares for $100 each, making a $1,000 total cost basis, and the stock splits 2-for-1, you now have 20 shares with a cost basis of $50 each. Your total cost basis is still $1,000. This is important for when you eventually decide to sell your shares and need to calculate your capital gains. Finally, use this event as a valuable learning opportunity. Pay close attention to how the market reacts in the days and weeks following the split. Does the trading volume increase significantly? Is there a lot of discussion about the stock in financial news and online forums? Watching these dynamics play out in real time is a fantastic way to deepen your understanding of market psychology and investor sentiment. It provides a real-world lesson on how news and corporate actions can influence stock behavior, separate from the underlying fundamentals of the business. This observation will make you a more experienced and savvy investor for the future. Once the stock split is complete and the dust has settled, it's time to shift your focus back to what truly drives long-term investment success, the company's fundamentals. A stock split should never be the primary reason you decide to buy, hold, or sell a stock. It is merely a signal, a piece of the much larger puzzle. The most critical mistake an investor can make is to buy a stock just because it is splitting. This is akin to buying a car simply because the owner gave it a new coat of paint, without ever checking to see if the engine runs properly. The new paint job might look nice, but it won't get you where you need to go. Instead of getting caught up in the short-term hype, use the split as a trigger to reevaluate your original investment thesis. Ask yourself the tough questions again. Why did you buy this stock in the first place? Has anything about the company's business model, competitive advantage, or management team changed for the better or worse? Dig into the company's most recent financial reports. Look at its revenue growth, profit margins, and debt levels. Is the company still innovating and executing its strategy effectively? The answers to these questions are infinitely more important than the nominal price of a share. If you were considering buying the stock before the split, but felt the price was too high, the new, lower price point might present a good entry point, but only if your fundamental analysis still holds up. The lower price makes it more accessible, but it doesn't automatically make it a better value. Value is determined by the relationship between the price you pay and the future earnings you expect the business to generate. A stock can be just as overvalued at $100 per share as it was at $1,000 per share if its business prospects don't justify the price. Your decision should always be rooted in a sober assessment of its intrinsic value. Ultimately, preparing for a stock split is less about taking action and more about reinforcing good investment habits. It's about staying informed, remaining disciplined, and keeping your eyes fixed on the long-term horizon. Successful investing is not about chasing short-term market fads or reacting to cosmetic changes. It's about partnering with great businesses and holding on as they grow and create value over time. A stock split can be a positive sign that you've invested in one of those great businesses, but it is the business itself, not the split, that will build your wealth.